When a global benchmark for oil shipping is allegedly distorted, the fallout does not stay in the Middle East, it lands directly on the Singapore Exchange balance sheet. For any investor holding SGX for its monopoly safety, a lawsuit involving hundreds of millions in losses is a loud wake-up call for your dividend security. Today we audit whether the 2026 Nasdaq bridge is a genuine lifeline or a distraction from mounting litigation risk. I have been watching this one for a while, and the number that finally made me sit up was the gearing figure. This is one of those pieces where I had to run the data twice because I did not believe it the first time. Most financial content is built around excitement. What is surging, what is breaking out, or what you might be missing. I am deliberately building something different because retirement-grade investing is not exciting. It is disciplined, forensic, and it is designed to still be working when you need it most. We are putting 4 counters under the forensic lens today to see if those dividends are actually as secure as they look on paper or if global distortions are starting to hit our local balance sheets. The Straits Times Index closed at 4,942.94. Psychological resistance remains firm at the 5,000 mark following the recent relief rally. The 6-month T-bill cleared at 1.40%, continuing its slide from the prior auction. This matters because my forensic floor remains at 3.2%. Once we add the mandatory risk premium, our minimum yield hurdle stands at 4.7%. I audit for the storm, not the sunny day. I do not lower my standards just because the market takes a temporary dip. Turning to the Singapore Exchange, we have an operational fortress that is currently looking like a valuation trap. At $21.56, the forward yield sits at approximately 2%, a decisive failure of our 4.7% minimum yield hurdle. The interest coverage ratio of 45.4 times and the net cash position are operationally exceptional, but the yield gate overrides both. The immediate concern is Mercuria Energy Group suing an SGX subsidiary over alleged benchmark distortions. Claims are running into the hundreds of millions. The sovereign catalyst behind the recent pivot is the $6.5 billion equity market development program, driving the Nasdaq dual listing bridge by mid-2026. But the litigation risk is a massive near-term hurdle. A 10% provision against those alleged Mercuria losses could reduce projected special dividends by over 15% if a negative ruling lands. With a valuation 68% above the 3-year average, there is very little margin of safety here. For a 55-year-old holding this as a defensive pillar, that 2% yield simply does not clear the retirement income threshold. The market is currently cheering the penthouse view of a Nasdaq bridge. And here is what matters: forensic investors need to check the basement. Mercuria is not suing for small change. We are talking about hundreds of millions tied to the pricing integrity of the Baltic Exchange. Reputational damage to a core subsidiary is a structural risk that no dual listing bridge fixes overnight. My fair value estimate sits at $13.94, a significant gap from the current price. That gap is not a growth premium, it is the cost of patience. Staying on the sidelines is the only play until the litigation is quantified. Moving to NEO, we are firmly in the red zone as growth is stalling while capital burn remains critical. April deliveries came in at 29,356 vehicles, a significant pullback from the 35,000 units delivered in March. While year-to-date growth looks spectacular on a billboard, the monthly volatility signals that NEO has not yet achieved the escape velocity required for sustained profitability. The full year 2025 net loss was nearly 15 billion yuan. A single profitable quarter is a positive signal, but not yet a trend. Unlike the multi-segment fortress maintained by BYD, NEO's SGX-listed shares fell 5% to $6.16 as the market priced in the delivery pullback. Because it is denominated in US dollars, it is ineligible for CPF or SRS, removing any tax advantage justification for a Singapore retail investor to hold it. The equity cushion stands at only $595 million against total liabilities of $16 billion. That is almost no buffer for a macro shock. This is not an investment for a Clementi parent with kids approaching university. It is a high-stakes delivery lottery. That 71% year-to-date growth looks great. But the forensic story is in the month-on-month pullback from 35,000 units down to under 30,000. This suggests the new model hype or subsidy rush is already cooling off. On the SGX, the 5% haircut shows the market is losing patience with a growth-at-all-cost strategy. Without a clear path to positive free cash flow across a full cycle, every delivery dip is a warning signal on the debt wall. Zone 5 stands until the interest coverage ratio is positive for 3 consecutive quarters. For Mapletree Logistics Trust, currency headwinds are starting to erode the fortress walls. The headline distribution per unit for the financial year declined nearly 10% to $0.07262. Even stripping out divestment gains, the operational decline was 3.4%. the 5.95% yield clears our hurdle. But the interest coverage ratio of 2.9 times fails the Zone 4 floor of 4 times. With gearing at 40.6% and net debt to EBITDA over 10 times, we have 2 hard gate failures and 4 soft flags. Management has hedged 75% of distributable income into Singapore dollars for the next 12 months. But that is only a temporary shield. If regional currencies do not recover by 2027, the hedge expiry creates a permanent step down in net property income. A 10% decline in earnings would push the interest coverage ratio down to 2.6 times, leaving the trust one macro shock away from the red zone. For a Jurong resident holding 50,000 units, this represents a nearly $400 reduction in annual passive income. The Mapletree Fortress just took a direct hit to its payout. Divesting older assets at a 20% premium is sound capital management. But that income gap is not being filled fast enough by new acquisitions. We are essentially seeing the trust sell the present to fund the future, while the Heartland investor absorbs a smaller quarterly check today. At $1.22, the yield clears the hurdle, but the balance sheet metrics do not inspire confidence. The distribution is not a trap yet, but the balance sheet is already in the caution zone. For a deep dive analysis, watch out for my separate video focusing on the results from Mapletree Logistics Trust. In a bit of a triage situation, Parkway Life REIT stands out, with Singapore healthcare assets carrying the entire portfolio. First quarter distribution per unit rose over 15% to $0.0442, driven by greater rental contributions from our local hospitals despite a revenue dip in Japan. For a retiree in Toa Payoh, this unit remains a sanctuary play with a growing distribution. It continues to outpace the current 1.40% T-bill and the 4% CPF special account benchmark, making it a rare bright spot in this audit. While institutional desks are focused on the Nasdaq dual listing bridge as a re-rating catalyst, the forensic view is much more immediate. The Mercuria lawsuit is a larger near-term risk than a bridge that has not even opened yet. If a settlement for hundreds of millions proceeds, the $21 share price will fail the internal stability stress test at current yield levels. We do not trade on the promises of 2026 when the litigation and benchmark integrity issues are already sitting on the balance sheet today. Looking at the yield spread against the 1.40% T-bill rate, the divergence in the market is clear. SGX offers a measly 0.60% risk premium, well below our forensic floor. NEO is at a full stop with no yield and negative spreads. Mapletree Logistics Trust offers a healthy 4.55% spread, but it carries significant leverage risk. Meanwhile, Parkway Life REIT is flashing a sanctuary signal. My forensic floor does not move to match market rates. We audit for the storm, not the sunny day. In this market, the difference between a sanctuary and a yield trap is often decided in a single trading session. By the time this analysis reaches you as a free subscriber, the entry window I identified has often already opened and often closed. Iggy's elite investors get 0-day access to these forensic breakdowns the moment the numbers land. If you want the full red zone watch list and the institutional grade cheat sheets before the market moves, check the link in the description to join our elite group today. Iggy's elite investors do not just get the report earlier, they get it when the numbers still matter. You get the full red zone watch list and the forensic tools at the moment the setup is live, not after the market has already priced in the news. For $9 a month, which is less than a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity and you start being the analyst. It is about having the data before the crowd, ensuring your retirement stays on track regardless of market volatility. To summarize the bottom line, SGX is a caution until the litigation is quantified and the price corrects toward fair value. NEO remains in the red zone. The growth engine is not yet self-sustaining, with no yield and negative interest coverage. Mapletree Logistics Trust clears the yield hurdle, but the balance sheet requires a close watch on regional currency trends and interest costs. Parkway Life REIT is the standout, proving that Singapore healthcare is doing the work that the industrial and exchange plays currently cannot. This is the divergence between Farrer Park and Raffles Place. While the suits discuss dual listings, the Heartland investor is looking at a nearly 10% pay cut from their logistics holdings today. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a licensed financial advisor before committing funds.